Hi, I'm Marty Grisani, and this is The Marty Grisani Show. As a full-time real estate investor and business owner, I have a real fascination of finding the key principles for business success and personal development. This show is a reflection of my personal mission to find out what truly makes somebody successful in business and in life. We will find tools and tactics that they've used to reach those levels. If you're the type of person is not satisfied with average and you have a hunger for learning that will never cease, this show is for you. Welcome to the show.
Computer. All right, boys and girls, I'm real excited for this show because this is actually his third appearance, and every single time it's eye-opening on what you can accomplish, especially from where you come from, right? Especially if you don't come from a background of affluence and maybe having the best living situation and parent situation. And you guys can go back and listen to that to kind of hear the full story. We want to talk about what's going on next in this individual. Today we have Jarred Elmar on the show, the CEO and president of the Geneva Group. And I'm excited to talk to him because he is he's doing two things that are very exciting. He's stepping back into one industry that he hasn't been in for a little bit of time, which is the multifamily. He's always been passionate about it, and we've talked about that on other shows. He's going to talk about a deal that he just did there, and 200,000+ square feet of industrial warehouse, which has been his bread and butter for the last 10 years. But anyway, without further ado, Jarred, welcome to the show, buddy.
Thanks as always, Marty. I appreciate it.
I appreciate you.
It's been it's been fun. Obviously, you mentioned multifamily. We started with multifamily. It was our first real commercial deal. I mean, I consider that was 156 units back in 2010 in Atlanta, and that's really where I evolved from single family rentals in Atlanta and kind of did real life monopoly. I sold those houses and traded up for apartments and got my master's degree with apartments on that deal, murders and fires and strong arm robberies. And so I was a little gun shy to continue to build a portfolio with that. And so it's nice to be back where it all began in Atlanta with our first apartment deal since 2010.
Probably a little bit of a different change in price per unit from that first one. I remember you were telling me it was something bananas like 15,000 a unit on that first deal.
9,700 a door. That was the first deal. Yeah. Wow. So you can imagine the neighborhood it was in. If it was right. 9,700 a door, even back then, it was as hood as it gets.
Right. And you still came out of it, obviously unscathed. You did well, and that was kind of the launching point into into what you're doing. But let's talk about your reentry into Atlanta in regards to multifamily. I know you've done other deals there, but tell me about this. How did this come about? I know you, again, like I said, you've been passionate. You talked about this in previous shows. Yeah, if we would have caught them all, one of your things that you said before was, hey, I guess I wish we would have caught the multifamily train as well. We kind of just didn't do that, and that maybe have been something where, if we focused there, it could have been something very large. Our company could have handled and done that and done well there. Obviously done well in other industries, but kind of maybe missed that multifamily train for a second. What are your thoughts on why you love multifamily? Why are you, so excited about this deal, and how did this deal come about?
Sure. Yeah, I mean, listen, in hindsight, right? Hindsight's always 20/20. We should have kept multifamily in the mix, but we're always going to be fundamental investors. If the deal doesn't work on paper, the economics don't work, we're not going to buy it with the hopes and the anticipation of the value going up over time. Because guys like us, I mean, we're not Blackstone, so we need sustainability. So you can't overpay for multifamily with the mindset that if I hold it for 10, 15, 20 years, at some point I'll make a profit. It doesn't work like that with the way we raise our money. And the investors that we have involved. So in theory, it would have been nice if we kept multifamily in. And who knew this train was going to run as long as it did? But now all of a sudden it stopped, right? And a lot of people are getting caught with their pants down on this asset class. You have I'm sure that this has been really all over the news and the press, so I'm probably not saying anything that your listeners haven't heard before, but you have plenty of apartment buyers that didn't have a huge war chest of capital. They would raise it through syndication models. They would raise it through high net worth individuals, country club money, maybe some family office. But when it comes time to ask for a capital call, when a property doesn't go well, or rents flatten out, expenses shoot up, and interest rates shoot up, so values are lower. When it's a perfect storm like that, most of the syndicators out there absolutely either shut their distributions off or had to fund to either right size their loan or to cover the costs of the increasing expenses on multifamily. And that's happened. And all these guys, because they were buying such razor thin margins back in 2021, when rents were doing this and rates were down, interest rates were down here, they had no choice but to float debt. They weren't locking in long-term cheap debt because they wouldn't get good leverage. It wouldn't meet a debt coverage ratio. So everybody that was in a syndication model, and even the most seasoned guys in multifamily, they all floated debt over the last 2 years. And I know some guys, 10, 15, 12, 20,000 units. And the last 5 or 6 deals that they bought, large deals, $80 million, $120 million deals, they floated debt with the expectation that rents were going to continue to do this, rates were going to stay low, expenses weren't going to blow out, and they're all hemorrhaging and they're all stressed. So that's a perfect, that's a perfect dovetail into our segue into how we got this deal in Atlanta. We got a 240 unit apartment complex, and it's the same story I just mentioned. The guys over leveraged, they floated debt on more than one asset. Their portfolio as a whole was in trouble. They had to sell some quality assets to get rid of, sustain the rest of the portfolio. So this was situational. The loan was coming due the month that we closed. We knew that going in. It was a heavy lift. We knew it was going to be a lift because all they had the money to do was put Band-Aids on a 70s vintage property. So we knew we had a lift. We knew we had a lot of the systems, the systems in the apartments were well beyond their life expectancy. So we knew we had to permanently fix that. And the last 2 ownership groups put those Band-Aids on the properties. And quite frankly, it's been more of a lift than we anticipated. But we're back up to 94% occupancy. We inherited about 14 evictions. Awesome. We're down to 4.
Awesome.
And rents have without a doubt flattened out.
Right.
We're figuring in the next, and we're starting to cut out our concessions. So we knew this. We knew it was going to be a 12 to 18 month turn. But again, if you buy right, it's the same thing with my deal in 2010. I had a murder within 30 days on that apartment deal. I thought I was doomed before I even started my commercial career. And it worked out really well, but only one reason only. I caught the market at the lowest point. So everything could have went wrong and I still would have made a profit. Now, if you're buying that apartment complex and you have delusions of grandeur that you can pay $100 a door for that property, I paid $9,700 a door. Right. You're going to be caught. There's just no way you're going to ever get the value back because those type of properties you have to renovate every 12 months. They just get beat up. So this one was a B market, but a C property, and it was only a C property because the last 2 buyer groups were just playing the hot potato game. They weren't really putting real money into it. They were just letting the market momentum, drive up the price, and they sold. So, listen, we're still looking at multifamily. Most multifamily still doesn't make sense. There is a lot of cash on the sidelines ready to pounce on multifamily as, there's dips in rates. But we're going to get our piece.
Flipper mindset, we talked a little bit about that, like a lot of times with syndicators, you are a flipper, right? And you have to be really in order to.
That's the model.
That's the model. And, I want to talk about this really quick. And then I got some questions in regards to what you just talked about. But, is that the right model for, I would say, an up and coming group that is looking to, do deals, build credibility, make sure their investors are taken care of? And, is that the right model, or do you hold it and try to figure that out? And I guess, start, becoming more of a, hey, we buy and hold, and then we manage these properties and we fee through the management system. Like, what's your thought there?
My thought is that if you're looking for, if you're looking to build a business, a fee-based business, and you're looking to do volume and you're looking to make a very good living, I do think that the institutional route, or a fund model could make sense. I think it allows you to, if there are opportunities in the market, you can snatch them up very quickly. You can do volume. You have to do volume in those models because you're not keeping a ton of ownership on those deals. You're really fee based with a back end promote that you hope that's going to be there, and you have to sell, right? Those models, they're 5-year holds, 3-year holds. The best thing we ever did was not go the fund route, not go the institutional route. The best thing we did, and I didn't realize that until here it is, 13 years later. The fact that we syndicated and the fact that we have an investor base that are retail investors, $200,000, $300,000, $500,000 investments at a clip, allows us to have flexibility. Most of the investors that we have are looking for income. They're not looking for the big pops. They like it when it comes, as long as we can redeploy the money. But the idea is that they're investing into real estate long-term to get the tax benefits and get the cash flow. And we've been very disciplined to find investors that align with the model that we want to build our business. So it's a little bit of a loaded question because your listeners might be different. Some might say, look, I don't have the investor base and I don't want to spend 5 years building my investor base. Let me just find one investor. Well, maybe you go the private equity route or the family office route, but just understand that you have a major master to serve. And I have a lot of little masters to serve, but at the end of the day, I have much more autonomy than if I had a private equity firm where, quite frankly, most bigger quality private equity firms, guys like us are their glorified acquisitions bitch. That's what we really are, with the hope that we'll get a little piece and we work for fees. You don't get uber wealthy doing that.
I think that's the big difference. Like you said, I mean, it's, again, great life, income wise, but for like wealth, generational wealth, that's probably not something typically that's not the model. It's just not the model with that. Okay, let me ask you this, because this is a great thought is, hey, all right, you guys have so many great systems down, right? Let me ask you this, because you had so many great systems down for industrial, retail, right? Because that's really what you've owned for so long. Okay. How does that look when you jump into, because let me ask you this question. Did you have multifamily at all before you jumped back into the 200 plus unit apartment complex? So what is that system to go back into that with, there's obviously been changes in software, changes in all these different things, and it's not the same software as what you have with industrial and retail and office. What was that learning curve look like? And were you able to keep the people on? Because, for me, I'm at the apartment, right? Like I told Jarred, and Jarred knows that we own a 79 unit apartment building. I am the management. I am showing units, right? I'm in there. I'm in the gut. I can't imagine what it would have been. Obviously, you can't do that. And your team is not in Atlanta. You guys are in South Florida. So what does that look like?
And look, there's pluses and minuses with the way we did it. We're opportunistic, and we've managed and we've owned virtually every product type: office, retail, medical office, multifamily, industrial. So we know how to manage all the assets, and the way we buy, it's got to be all fundamental. We put our money where our mouth is. So 10% of the equity that we're raising comes personally from me, from the office. It's very different than if you have a private equity firm with maybe they'll do a 90-10 split or 95-5, and you have acquisition fees that ultimately offset how much money you put into it. So really, theoretically, when you're with the larger groups, you can get away with really having no money out of pocket. So that there's an allure to that. But again, that's why you don't keep a lot of ownership. You're heavily diluted. Whereas the way we've done it, we keep a lot of the ownership, we keep a lot of the tax benefits, and as rents go up and as the mortgage gets paid down, you just continue to add to the bottom of your personal financial statement, as that, as the market, as you have time in the market. But as far as all the different product types, we needed to be opportunistic, and have a volume of lead flow. And the only way to do that is we had to look at everything. We weren't willing to put our money where our mouth is on average deals. You can do that average deal with a private equity firm or a family office, right? You don't have to, you can play around with a model and, convince yourself that the returns are so much greater. But when you're actually putting your money into it and you have all these investors that are relying heavily on you, not so much the underwriting, we just won't buy an average deal. I like, let me just take a step back. The negatives with the way our model is, having office, retail, industrial, multifamily, all in the mix, it does make it difficult to train your staff, because the lease structures are different, the TI packages are different, the tenant base, the demographic of the tenant base is different. Do you need bilingual? There's just a lot of, we have the most savvy bit. We have Boeing as a tenant, and we have Johnny's Automotive as a tenant. So it's very difficult to train your staff to bounce between all these different type of product types and tenant base. But it allows us to be, for us, the way we raise our money, it allows us to be sustainable. COVID was a perfect beta test for us. When retail was non-existent during COVID, especially experiential retail, industrial went through the roof. So retail prior to COVID was our front runner. I mean, that was, the value, the appreciation in our retail went up dramatically. Our industrial did okay, but retail was the outlier. Then it flipped. After COVID, industrial went crazy, retail flattened out, and then you know what happened with office. So it was good that we had a balanced portfolio. So I after COVID, I'm like, you know what, this is the model that we're going to stick with. Now, the other negative, doing it the way we did it, is if you have millions of square feet of one product type, well, now you have a possible takeout, an institutional takeout, where an institution is interested in your entire portfolio. Case in point, multifamily. You have 10,000 apartment units. There's a good chance that you're going to compress the cap rates on that portfolio to sell the whole thing, because there's scale for a larger firm. You don't have that when you have a mishmash of product types. So that's the negative. But if we're not looking to sell, then I truly believe that because we were so selective right at the onset, that the value is going to go up so much faster, or so much higher over time. And that's really what we decided to go with, is the opportunistic route, where we build our portfolio, we hold on long-term, we find investors that only want to stay in the deals long-term. And it doesn't work for everybody, but it's been good to us.
So when you're looking now, okay, at multifamily, are you saying, okay, because you have management in-house, but you're not managing something out there in-house, or are you strategically finding the right property manager? Or is it even sometimes, I like this property manager so much, I might start looking just for more and build around them because of how valuable a legitimate property manager is?
Yeah, all the above. When we initially, early on building the business, we self-managed 100% of what we bought. And that was to get our arms around it, earn while we learn. I mean, we were still young in the business, and I wanted to understand the product types, and I want to understand, the nuances. So when it's time to evolve and scale, and be more efficient and hire third party, we know what to look for. We know what to ask. We know how to read the reports. So that's how we've always done it, is we manage first, get it stabilized, wheels up, and then we pawn it off to a third-party manager, and then breathe over their shoulder as they're managing. When it's long distance now, just because of efficiency, for the purposes of efficiency, we'll third-party manage. So multifamily, 240 units. We weren't about to hire 5 staff for that property. We got a third-party manager that had assets around the area, similar class, so they knew what we were up against with a heavier lift, and we're monitoring them very closely. We have an hour and a half call each and every week for CapEx, that all the investments we're making into the property, and for leasing and management, to understand where we are on the delinquencies, the evictions, concessions, leasing traffic.
Well, it sounds like you're picking a winner with just the difference from where it was to where it's going. So I think that's great.
Yeah.
Obviously, it's always fluid, but having that, managing the manager and making sure that that's being done is something you guys do and do very well. So that's fantastic. Now, let me go back to maybe those 5, 6, 10 years ago, like you were saying, when you're kind of getting your hands in figuring it out. You have stuff locally, right? Do you lease? Do you have realtors on staff that will lease the stuff for you locally? Or do you broker that out every time?
We'll lease the smaller local stuff. So smaller office, smaller industrial, we do the leasing. On the larger stuff, 10,000-foot warehouses, 20,000-foot warehouses, retail storefronts, we'll hire a national brokerage firm most of the time. And again, I say national brokerage firm because we're in a major metro area. Many times, if your listeners in a smaller market, local brokers are better. So yeah, we definitely use third-party leasing on most of our, I'd say 2/3 of the portfolio.
On the mom and pop stuff that you do lease, what does that hand-to-hand combat look like? Because I know it's hand-to-hand. Like, is that you're on Facebook? Like, are you sending these, like, what does that look like? Do you have people reaching out through Facebook and just talking and chatting through Facebook or LinkedIn? I mean, or what does that even look like? What is the thought process? Because a lot of people listening do have like smaller industrial, smaller office, smaller maybe retail, and they're looking, how do I differentiate myself? How do I get that this thing's out there? And then, how do I get them in the door to look at the spot?
Look, there's investments that we made that we would have never made if it wasn't for how mainstream, so many of these social media outlets are, and marketing outlets are, where you can do it direct. Facebook Marketplace has been amazing for us. Craigslist has been amazing for us. Obviously, LoopNet and CoStar, but the smaller platforms like a Craigslist or more broad platforms rather, those have been fantastic for the smaller office units, for the smaller industrial units. And we would have never bought those management intensive assets if it wasn't for the fact that we know we'll get 5. There are times we get 5 leads a day for any one unit that becomes available. Now, it's always like we talked about before the show, location. We have office in East Boca Raton. That's a very strong office market, very limited supply. Everybody wants that address. If you're a business, there's a status to having that. So when you have these smaller office units, you have so many, and it's a densely populated area. You have so many different businesses that simply just want to either get away from the Amazon Prime driver and want to move the office out of the house, all the way to people that want to start small and then they start expanding into the other offices. We're 98% all the time with those type of products. We have 3 of those buildings.
Excellent.
And they all, I would say 90% of them come from Facebook Marketplace and Craigslist.
Amazing. That's just great to hear. And that's all, I'm sure.
That's office.
And let me ask you this. So in regards to office, is there a world where you're still looking at office?
At some point, not yet. We've gotten some at-bats. And we actually went after a big deal in downtown Fort Lauderdale, and we made a play on it. Very situational. We couldn't. The lender wasn't willing to take the hit that they needed to take on this, and I'm sure we'll get a second bite to see if we could take it down. But at some point, office will make sense. It's still got to flush through the system though. And quite frankly, the lenders out there don't want to take these assets back. So they keep just extending out. So though everybody's stressed and though occupancy is low on many, many markets, banks are pretending like it's not happening. So it's going to be a little while before those all flush through the system. And then all of a sudden there's some great deals. Because look, 75% of office product out there is probably obsolete. As it stands today, 75% is obsolete. But the 25% that remains is quality, high occupancy, good product, good markets, good pockets within a market. Those are going to be sold at discounts. And those long-term are going to be great investments. So at some point, we'll start looking at office again. I always liked office. Just with today's construction costs, the TI packages that the tenants are expecting in today's environment, rents continue to go down. There's just too much bad news right now, and lenders still have not gotten on board to finance
Right.
most offices.
Right.
So it's just so
one.
difficult, and it's like you're beating your head up against the wall, even if it's what seems to be a good deal. At some point, all that will, it's in its infancy stage right now, and at some point it'll all flush out, and office is certainly not dead. Just maybe 75% of it might be close to dead.
You've seen this before, and so this isn't your first rodeo, but how the extend and pretend, why does that come to an end? Why can't that just keep going? Like, what is the reasons why that a bank would then have to sell these things? Or is it, I guess I don't know, because they're doing it. I mean, I've seen it. Something's happening that I don't understand, and I just don't know when it's going to finally be the pain that people kind of talk about that's happening. And I just don't see that yet. Is it, in your opinion, do you think it's because I think the job market hasn't been hit yet. I think when there's an actual job market hit, now we're going to have real pain. Or I don't know, is it they're lowering interest rates? That sounds like that's what's happening with the Fed, but what is your thought process on just that part of banking in general, I guess?
I mean, I would defer to my lender buddies, but a lot of it's regulation. At some point, these banks get stress tests. They look at what the loans are. They look at what the debt coverage ratio is, and at some point they get the boot to their neck that they've got to start flushing these assets through, or really putting the screws to the seller. Right now, I mean, look, I'll be the first to tell you, we have a troubled office building in Orlando. It's a medical office building. It doesn't make any fundamental sense why we're having trouble leasing it. It's medical, second generation, across the street from a hospital, all the things that you want, but we're having trouble leasing it up. And right now it's 46% occupied. That is well out of covenant compliance with our loan. And we've had these hard conversations with our lender, and the lender basically gave us 3 or 4 options on how to kick the can down the road. And all 3, at least 3 out of the 4, were absolutely something we'd be willing to do. Which tells me they absolutely don't want this back. They're looking for ways to maybe put themselves in a slightly better position, but not by much. And with the hope that the market's going to come back. Look, if this proves to be true and technology is going to continue to get better, remote work is going to continue to get more efficient, at least on a technological standpoint, who knows what's going to happen with office, but you can argue the other side too, where, people are, there's no growth, there's no the productivity is dropping. There's no mentorship. Students that come out of college that absolutely need the on-the-job training direct with seasoned professionals that are colleagues in their office. That doesn't happen, in the hybrid world. So you can argue both sides. Productivity goes down. Every big company is going to be bringing everybody back to the office. That's already happening in the tech sector. So that's why I think quality office is absolutely 1000% here to stay.
That's such a great point about the mentorship. I never thought about that. That's so true. And that's how you could be optimistic about office, and with other things about being in the right places. And so, okay, let's talk about, so I don't know we have too much time left, but tell me about the industrial warehouse property, the 218,000 square feet. How did this come about? We kind of talked about this off camera. where you team up with another group. What does that look like? And obviously this has to be a win-win when you team up with another group. And so what's the Geneva group doing that's going to be something that seems that's valuable to them? What are they doing that's valuable? And how do you structure something to make that partnership work long term?
So we've had actually four different joint venture structures and four very different parties that we joint ventured with. One was a very close friend, a mentor, a guy who really knows industrial, and we joint ventured on many deals, and it's worked out really well because we complemented our skills, and we were able to divide and conquer. Maybe one guy's boots on the ground, the other guy does accounting. So it spreads over more resources rather than just being concentrated in one office. That worked out well, and we'll continue to do deals with that individual. Then we've had a private equity partnership. And that one was, you learn very quickly that you have no say. You have your input, but you have no power. And when they want to sell and when they want to, refinance or whatever, they have all the power, and you are a glorified acquisitions, person. So that's not something we would look to do quite like that again. And then you have what we did in Jacksonville. Jacksonville is 218,000 feet, so there was some economies of scale, to bring another group in. For self-serving reasons, almost out of necessity, we did a huge raise on the apartment deal that we just talked about 4 months prior, and I wasn't quite sure where my bandwidth was on raising equity, 14 million of equity on the next deal 4 months later. So we worked with this basically a fund manager. In the past, we tried to do a couple deals with them in the past, and for one reason or another, it didn't work out with the seller. So we knew them, we trust them, and we knew their office, their back room, and once again, their skills complemented our skills. So that's a deal where it actually worked out so well right out of the gate. They have a fund model, we have a syndication model. Our promote is very different than their fund model. Our fee structure is different than the fund model. So the returns on their side and their investor side may look a little different than the returns on our side. Not one is better than the other, but it's nice to know that you have that flexibility where you don't have to have it all uniform. You can say, look, we'll divide this deal in half. Half the deal's yours, half the deal's mine, our investors, and we manage by committee, and we manage together. That's worked out well for us also. And this group, it worked for them at a necessity. They were only 20% deployed in their fund, so they couldn't have so much concentration risk on one asset in the fund. So they can only take a piece of this deal anyways. So it's either they had 50% of the deal or they couldn't buy the deal. They had to find another group. So it was a perfect win-win on this deal.
That's great.
And then when we went through the tenant interviews, we found out that one of the main anchor tenants had a building under contract down the street, and we were going to lose them, which would have dropped occupancy, which affected value, which meant we needed to retrade the deal, ask for a discount, and who knew if we were actually going to close on the deal, if the sellers were going to take it. The group that we were with, we brainstormed, and together collectively, we came up with the idea of selling that building that they currently occupy to the tenant, getting them to pivot off the building that they had under contract to buy the building that they're already in, because they owed us 2 years of rent. They had an ability to grow into it. They didn't have to deal with the move and the stress of the move. And P.S., they're buying that building. They're buying it at a slightly higher basis than we're buying it, which lowers our price per foot on the rest of the complex. It also takes a lot of that vacancy out of the equation. So now we're really fully stabilized. And we sold them the inferior building. It's behind the other building that's on the main drag. So we didn't really lose a quality part of the complex.
Wow, that's sweet. That's awesome. That's awesome. And that's so awesome for so many reasons, because you could have been just like, okay, we're done. Like you could have just been done. And then, but because you're, problem solving, we're in this world of constantly trying to problem solve. You're able to keep the tenant. They want the building. They don't want to move. Nobody ever wants to move. And you sold the inferior portion of it, and now you're more occupied than ever, and so now you can go back to a bank at some point and refinance, and then it's an amazing thing. It's great.
So, and that one looks like, and it's all going through, and it really changed the underwriting. It changed the numbers. I think
Sure.
originally this deal was like I think it's 17, 16 IRR, 16% return, and it jumped to close to 20 when we re-underwrote with
Unbelievable.
being sold off, because there was a lot of dollars that were going to go into that building, new roof and some other capex.
Unbelievable. Yeah, that's one less thing you guys have to even worry about managing.
Right.
Just fine.
It's much less management intensive asset now. So
Yeah. No, that's fantastic.
That comes from working with, if you're seasoned, not seasoned, working with a seasoned group, you're bouncing ideas off of each other all the time, and things, things flourish from that mastermind.
And you'd love to do many of those deals.
Yeah. That one's good. It's working out well. Yeah.
That's fantastic. Jarred, I really appreciate you coming on. It's always a pleasure. You always bring it. You always have some unbelievable new things that are happening. I'm a big fan. I'm happy for you. And obviously, if there's anything in Rochester, if you're ever looking out this way, you know to call me, and I will.
Trust me, you're my guy. When I'm ready to invest in New York, you're the only one I'm calling.
All right, brother. Guys, that's Jarred Elmar. If you're ever looking for information, he posts a lot on LinkedIn. He's the Geneva group. They're in South Florida, and they're always taking on investors if you're the right investor for their model and for what they're doing. And I can tell you they do a really good job. So, Jarred, thanks again, guys, and take care. And we will see you next time. Bye-bye.
Thank you for tuning into the Marty Grisani Show. If you're listening on Apple Podcast, leave us an honest rating and review. If you're on Spotify,